Well, consumer prices showing signs of cooling in the latest CPI print. Annual headline inflation coming down to 4% in May. But overall core inflation remaining sticky, rising 0.4% last month. So how is this going to impact the Fed's decision on rates tomorrow? We want to bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's good to see you here. So taking a look at the market action today, it looks like they are viewing this as even more evidence or a higher chance that the Fed is going to pause tomorrow. What do you think?
Yeah, I think it's put a little skip in Chairman Powell's step. Maybe we don't get a rate hike at this meeting. Maybe July would be the last one. I think we're going to get the dot plot. Of course, we're going to get the dot plot. We're going to get Fed Chair Powell's comments, which may signal a bias towards maybe one more hike at the July meeting. But look, even with the data we got this morning, we can't entirely rule out a rate hike. It's unlikely. But look, we saw surprises from the Bank of Canada last week and the Reserve Bank of Australia last week. They both had paused hikes in prior meetings and then had to come back and hike again. This is the risk for the market, getting more and more comfortable around the idea that we are at the end of this series of rate hikes. The Fed remains data dependent. And if the data surprises with inflation in the coming months, as it could potentially do, as we saw in Canada, Australia, other major countries, that's a possibility as we look out over the course of this summer, particularly given potential developments with regard to the war in Ukraine and so many other factors that can influence prices.
Jeffrey, Diane here. I want to ask you, okay, the expectation largely for a pause at tomorrow's meeting. At the following meeting, do we see the Fed kind of continuing to hold steady, or do you anticipate it's going back to another hiking cycle?
At the moment, the market seems very convinced of another hike. One of the reasons why I think that's possible is if we take a look at something called the output prices component of the Purchasing Managers Index. The PMI is a survey of purchasing managers at businesses around the U.S. In fact, it's done around the world. And they ask, one of the questions they ask is, what are you getting on pricing? What's your outlook for pricing on the goods you're selling over the course of the next several months? And that is usually a 6-month leading indicator of where overall consumer prices are headed. It's actually a really good indicator over the last 20 years. And that's pointing to inflation in the U.S. halting its decline, remaining sticky around this sort of 3 to 4% range over the next 6 months. That may keep the Fed from being able to declare all clear on the rate hike front. So even though we may just get one more in July, they may not be able to tell us that's absolutely the end of the cycle.
Jeffrey, what do you think is priced into the markets at this point, just in terms of there's so much riding just on how Powell shapes the narrative at the press conference tomorrow?
Well, certainly some of the high-flying tech stocks, particularly AI names, very, I think, tied to this environment of the return of a flood of liquidity, maybe the potential for the Fed to be cutting rates aggressively less than a year from now, and all that liquidity flowing into those, we know, liquidity-dependent type of stocks. So I'm a little worried about the very narrow leadership of the U.S. stock market, where we've really seen those stocks run away. In fact, the average stock in the U.S., looking at the equal weighted index, is only up 4 or 5% from the end of October, where the bear market ended. So really not seeing broad participation. That's not true, however, outside the U.S. We were seeing a bull market in the average stock up 21 or 22% for the EFI index since the end of October. So much broader, and I think able to withstand further rate hikes by the European Central Bank, whereas in the U.S. we might be more vulnerable if the Fed doesn't signal it all clear after July.
Jeffrey, we're hearing the R word less and less, recession. I got to ask you, you've talked about this indicator, it's a lesser known indicator, the cardboard box recession. Tell us what you're seeing on that front. And, again, we're seeing the R word less and less. So what are you seeing, and what is your data showing you?
Well, it depends where you're looking, right? So in the U.S., you might be hearing less about it, but last week's news makes it official. Europe is in a recession. In Q4 and Q1, they both had back-to-back quarters of negative GDP. The mildest ever is a total of negative 0.2%, but they are in a recession. It's not too surprising, but it's also too much of a generalization. Not everything is in a recession right now. It's what I'm calling a cardboard box recession. In a typical global recession, all areas of the economy turn down. Manufacturing, trade, services, retail, and construction, for example. And they do so around the same time. But now, only manufacturing and trade seem to be in a global recession. So I'm referring to it as a cardboard box recession. Things you make and ship tend to go in a box. And demand for corrugated fiberboard, that's what cardboard boxes are made out of, has fallen to a similar extent we've seen in past recessions. You can see it here in that chart, that purple line heading down, similar to what we've seen in those shaded periods of recession in the past. That's in contrast to service industries, which are still doing very well. So far, it's just a cardboard box recession, but I'm a little bit worried in the second half of this year. It comes out of the box, spreads a little bit into the service sector, maybe if the job market softens up.
So, Jeffrey, what does this mean then for investors? If you're out there trying to put money to work, you're looking at your call here, what you're seeing in terms of the trends of a cardboard recession, how should that then dictate where they are seeing or where they should be putting their money to work at this point?
So I think you want to focus on, remember the fact that there's probably going to be a good bit of volatility in the second half of this year with divergent economic trends and central banks unable to give us an all clear on the inflation front. And again, I think you want to look to markets where there's a higher quality component, meaning companies able to self-fund out of cash flow. They're not dependent on tighter financial conditions. And you can find more of those outside the U.S. I'd point to Japan right now as a market that's doing very well. By the way, avoiding recession in the last couple of quarters, booming growth, and actually seeing really strong performance. In fact, this is the 10th week in a row of gains for the Nikkei 225, something they haven't seen in 10 years. So this is a really strong performance in that economy as it's bucking the overall trend to global weakness, seeing stronger profit growth and still very attractive valuations.
But what about here in the U.S., Jeffrey? I mean, this hasn't quite been a broad-based rally yet. We're in the early stages of a bull run outside of, I guess, what's been dubbed the Magnificent Seven. What sectors are you seeing or do you suggest where investors should be playing?
You know, we're really focusing more on characteristics than sectors right now, meaning focusing on companies with higher quality characteristics, low price to cash flow, good interest coverage ratios, right? Those are the companies have been outperforming for the last year or so. I think they're going to continue. But if I had to pick a sector, one of the unloved ones right now is energy. You know, energy, oil prices just hit a real low, 3-month low yesterday. They're rebounding now. I think prospects for better growth in China as they're likely to cut rates this week. They cut overnight rates yesterday or this morning, but they're likely to cut their 1-year medium-term lending facility rate on Thursday. We're also seeing cooling tensions between the U.S. and China. Secretary Blinken is headed over there on Sunday after CIA Director Burns visited last month. So maybe tensions are easing a little bit. And I'd note that we're also seeing some pretty strong activity in terms of a profit revival there and some revival in consumer confidence. So looking at the demand picture for energy, particularly just coming from China alone, could be a brighter picture here as Saudi Arabia further cuts output kicking in next month. All that points to brighter outlook for the energy sector, which is often tied to the outlook for crude prices.
All right, Jeffrey Kleintop of Charles Schwab. Thanks for joining.